Recently, Mark Zuckerberg, founder of the social network Facebook and its parent company Meta Platforms, stated that Apple hasn't been able to invent anything great for a long time. In fact, Zuckerberg stated, "It's as if Steve Jobs had invented the iPhone and kept it unchanged for 20 years." In this video, we'll review Zuckerberg's opinion of the company, along with some fundamentals and the opinions of other investors, to try to determine whether this, which was once the #1 position in the S&P 500, the Nasdaq 100, and in the portfolio of the great Warren Buffett, is no longer an attractive investment. Let's start by reviewing Zuckerberg's opinion a little more. He stated that he's not sure iPhone sales are increasing, and that, on the contrary, they may be declining. Among other reasons, this is because each new generation of iPhone doesn't improve its features enough, so people take longer to upgrade their devices than before, which is why sales numbers are stable or even decreasing. But to make more money, they charge developers a 30% tax, which is more like a tax, and they receive revenue from the sale of peripherals and other accessories. Likewise, the company makes devices like AirPods, which, while great, are limited in connecting components from other manufacturers. Now, when reviewing some data, some rather interesting elements emerge that, to some extent, reflect the company's decline. On the one hand, it can be seen that after the tremendous drop in April due to uncertainty over the tariff issue, Apple has not achieved the recovery that other tech companies that are part of the so-called Magnificent Seven, such as Microsoft, have had. It is also noted that this year, Apple has been the worst-performing company of the so-called Magnificent Seven, with a drop since January of nearly 20%, even underperforming the S&P 500 index. Its poor performance on the stock market is so evident that in the ranking of companies in the index, it appears in position 471, practically at the bottom. In the fourth quarter of 2024, the company reported a 5% drop in global sales of its flagship product, the iPhone, losing market share to Chinese competitors such as Xiaomi and Vivo. According to Counterpoint, Apple lost 1% of its global market share in 2024, and iPhone sales declined by 2% the previous year, in contrast to the 4% growth of the overall smartphone market. In the Chinese market, Apple has also lost its leadership in the smartphone market, dethroned by its local rival Xiaomi, thanks to government subsidies, which allow for reimbursement of 15% of the value of consumer electronics priced under $820, encouraging the consumption of products from local manufacturers. Apple dropped to 5th place in the Chinese market, surpassed by rivals such as Vivo, Huawei, Oppo, and Xiaomi. Apple's share price has fallen from 15.6% to 13.7% in just 1 year. It's also evident how the great Warren Buffett has been continuously selling positions. He has sold shares since last year, increasing his sales in the second half of 2024 when the stock surpassed $200. Although it traded at over $250 at the end of last year, for now, the stock hasn't managed to surpass the prices at which Buffett sold massively. The reduction in Apple's share of Buffett's portfolio is not insignificant. For example, in the first quarter of 2024, the company held almost 41% of his portfolio, while by the first quarter of 2025, Apple only accounted for 25.8% of the total portfolio. When looking at profit growth, it has been increasingly smaller, with increases of less than 6% since 2022, demonstrating a stagnation in new iPhone users. Looking at the results in detail, the recent increase in profit is largely due to the increase in services revenue, which increased by 12%, while profit from iPhone sales only increased by 2%, and conversely, there is a reduction in operating cash flow. On the multiples side, the earnings ratio is at 31 times, above the average for the last 10 years. Overall, it's clear that most multiples are above the averages for the last 10 years, considering, as we've already reviewed, the rather limited growth in sales and profits. And it's precisely after Apple's last worldwide developers conference that investors were rather disappointed, as no significant advances were observed in its artificial intelligence. Although the company showcased its liquid glass technology, revamped its operating systems, and opened its AI to third parties, the market didn't welcome its announcements, which were perceived more as incremental improvements than major disruptive innovations. Investors had expected strong advances from Siri, its AI not yet at the level of its competitors. Adding to these disappointments, President Donald Trump has insisted that Apple produce iPhones in the United States, even stating that if they were manufactured outside the country, they would have to pay a 25% tariff. But if they were manufactured in the United States, iPhones would likely lose much of their appeal, as they would likely increase significantly in price, even tripling their value, due to the fact that most of the supply chain is heavily based in Asia, where costs such as labor and inputs are much lower. Just to give an idea of the change, experts explained how moving just 10% of its supply chain from Asia to the United States would take about 3 years and an investment of $30 billion. Analyst Oliver Rodzianko explains how the company's defensive moat could be lost due to the disruption of artificial intelligence in hardware, which poses a risk to the company's profitability in the medium and long term. In Rodzianko's opinion, management should focus less on share buybacks and instead dedicate resources to acquisitions and recruit the best talent for innovation and development in artificial intelligence. In recent years, they have invested approximately $100 billion in share buybacks, while R&D expenses are approximately $30 billion annually. This would show that the company has focused more on financial engineering, neglecting its moat in product development and improvement. The company has also not made any major acquisitions, with companies in the sector such as Microsoft investing $26 billion in the purchase of LinkedIn and $69 billion in Activision Blizzard. In contrast, Apple has only made 2 acquisitions worth more than $1 billion. But where the lack of investment is most significant is in acquisitions in the artificial intelligence sector, seeking to maintain the company's position, improve its recent slow growth, and update its products with more innovation. Apple's competitors, such as Samsung, are rapidly integrating artificial intelligence into their suite, combining AI technology into devices and in the cloud. Microsoft is also making progress to integrate AI into its hardware. Along the same lines, analyst Tim Grisky explains that while people historically like the company, growth has recently become increasingly slower, and the company hasn't offered any catalysts for growth, and it seems that artificial intelligence isn't contributing much. In Grisky's opinion, it seems the company is stagnant, and it's been a while since anything truly innovative has been seen in its releases. While it's still premature to say Apple is finished, its stock should be viewed with caution, and while new releases could lead the company back to sales growth, for now, we personally believe there are other alternatives in the technology sector that offer better opportunities. Remember that in the video description, you'll find the link to the best course to learn technical and fundamental analysis for investing in stocks. There's also a link to the best platform for buying stocks on the stock exchange, regulated in the United States. If you enjoyed the video, give us a like, subscribe to the channel, and share the content.